Hey everyone, Coach Investor back on our earnings video for today. So let's talk about UiPath's earnings report. It was a pretty good one. That's why the stock was up over 10% on Thursday when the majority of the market was red. Now UiPath, a pretty popular stock in the ARK Invest portfolio. Actually, if we look at the combined holdings, it sits today at number 4 behind Coinbase, Roku, and Tesla. Of course, the cost average here from 6 positions sits at around $63 or so. So not that great, especially if you know that the stock price right now sits at around $18. Now we're gonna have a look at the graph later on in this video. But first, let's have a look at what Wall Street thinks of this report. Basically, a lot of positive things. We've got price target raised from Barclays, Bank of America, Mizuho, Conaccord, RBC Capital, DA, Davidson, etc., etc. All of those price targets will be around $20 on average. And one of the analysts that has a buy rating and a $20 price target is one from Truist. So he noted that the results are indicative of early benefits in a change in its go-to-market strategy with more to come. So noted that the increase in free cash flow guidance to $250 million is a big positive. We believe Path is an automation leader and should benefit from the groundswell in generative AI interest, owing to its differentiated approach of combining generative AI with specialized AI, driving better accuracy and quicker time to value. More on that a bit later. So, the numbers. Revenue increased 19% year over year, and ARR increased actually 25% year over year. Cash flow from operation reached $44 million, and non-GAAP adjusted free cash flow reaches $47 million. Now, they did announce a share buyback, so they say here with more than $1.8 billion in cash, cash equivalents, and marketable securities, the UiPath Board of Directors has authorized a $500 million stock repurchase program, which underscores our confidence in the future and our commitment to building shareholder value. Now, $500 million might not seem a lot to you, but it is, I think, around 5% of the current value of the company. So pretty good. It also fights dilution. Now let's dive a bit deeper. So we have revenue that's consisting of licenses, subscription and services, and professional services. Now licenses, it's up 15% year over year. That was the older model, which has an extremely high margin. I mean, look at the difference here. That's pretty crazy. Then subscription services, that's up 28% year over year. Now, if you look at the cost of revenue for subscription services, that sits around 20% year over year, so it grows faster than its cost. That's always nice to see. Gross margin non-GAAP is at 86% for the overall business. If you look at gross profit here, nice increase year over year. What's also nice is to look at operating expenses decreasing, not just for the 3 months ending, but for the 6 month ending as well. So it's safe to say that this company is on the right path. See what I did there? Pretty smart, huh? And like I said before, the buyback helps with the dilution because if you look at stock-based compensation expense here, it is around 30 to 35% of revenue, but it is decreasing. Now, of course, there is no earnings report without talking about AI, but we know that UiPath has been dealing with this for a while, and they reiterate this on this slide here. AI has been an integral part of our platform. They also announced various new products, features, etc., etc. You can go over that as well. But basically what it shows you here is what happened before. So before it was a 100% human effort. Then with UiPath, you can see the majority of it is taken over by the robot or their program, their features. And then there is just a human review here. A human effort is now, let's call it 25% of the pie, which is exactly what you'd like to see, especially in this day and age. Now, overall, during the last couple of years, the company has been doing actually quite well. I mean, you can see it right here, ARR in millions, that is 38% CAGR from Q4 2021. That's pretty good. Dollar-based net retention rate 121% or 125% excluding FX impact, which means that the existing customers spend 25% more right now than they did before. Yes, here as well, the smaller ones are not spending as much as before because they're small, they're trying to survive right now. It's more of their biggest client that are spending more. We've seen this across the industry. Some companies are getting hurt. For example, we've talked about that with Twilio. Since the majority of their customers are still small, they're cutting back, and that's hurting a business like Twilio. This is hurting a business like UiPath as well. a bit less, I would say. And then as for guidance for Q3 2024, and yeah, that's that fiscal year 2024 because Q4 for them will end in 2024. So ARR between $1.35 and $1.36 billion. Revenue at $316 million at the midpoint, and then non-GAAP operating income of around $32 million. As for fiscal year 2024, ARR between $1.432 and $1.437 billion, revenue $1.27 billion, and then non-GAAP operating income around $188 million. Again, the growth here is exactly what you want to see, and expenses are coming down as well. So I'll make the joke again, they are on the correct path. Now, what is the market expecting for the following year? So for fiscal year 2024, growth for sales 20%, fiscal year 2025 close to 19%, and then fiscal year 2026 17.62%. Of course, these numbers might change over time. When we look at EPS for fiscal year 2024, huge increase from last year, so over 190% growth. Then for fiscal year 2025, 11%, and then fiscal year 2026, and reacceleration in growth there, 33.12%. And so right now, the company has a market cap of just over $10 billion, forward PE of 44.5 times. I mean, $10 billion, could this be an acquisition target? Maybe. Do share your thoughts down in the comments below. And then last thing here, the graph. Right now we are at a crucial spot, I would say. Of course, we have that huge green candle from the earnings. This is on the weekly chart, by the way. So we are now at $18. We've been rejected a couple of times at that price. Previously, back mid-2022, it was a bit of a support, I would say, $18 or so. Right now, we need clearly to finish the week strong and then start the next week on a positive note as well. Try and build a base around $18, but stay above that to create that support line and not make it another resistance point. So that will be it for this video. Let me know down in the comments below what you think about this earnings report. Do you own PAT in your own portfolio? Let me know down in the comments. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.